Hello, I'm Kim Parley, Vice President at TD Wealth, and I'm joined today by Syed Naqvi. He is Managing Principal at TD Wealth Family Office. How are you?
I'm good, Kim. How are you?
Good. And Colin Lynch, Managing Director and Head of Alternative Investments at TD Asset Management. How are you?
Good.
We are here today to talk about alternatives and more specifically the role of alternatives in an ultra-high net worth portfolio and what it can do. And Syed, I know you're going to focus more on the portfolio construction side. Colin, you're going to be talking more to us about the asset itself, or assets, I should say, itself when we get into it. But let's talk about the first thing first, which is how should alternatives be integrated into a portfolio? What's the right approach?
That's a great question, Cam. And I would start off by saying that the term alternatives is almost phased out of the industry because it was quite relevant at the time when public equities and fixed income were the dominant asset classes within a portfolio. But if we look at a portfolio today in 2024 and dissect it open, what we see is that complementary to public equities and fixed income, we have asset classes such as private equity, private credit, infrastructure, real estate, commodities, and I can go further on, art, watches, fine wine, So anything that is essentially a store of value is considered an investable class right now. So as capital allocators, our responsibility is that any asset class that helps our clients achieve their goals is of interest to us, and we will look at it. From a portfolio construction perspective, the principles do not change though. And what I really mean by that is that just because an asset class exists doesn't mean that it needs to be represented in the portfolio. We really have to go back into what are the end objectives for our clients, what type of time horizon we're looking at, what's their liquidity requirement, and what's their tolerance to volatility, for example. Then we'd have to take it a step further. So outside of the investment portfolio, what type of exposures do our clients have? So as an example, in Canada, clients tend to have an overweight towards Canadian real estate on their personal side. Mm-hmm. That's just the nature of how our economy is. So we want to make sure that we're not duplicating or amplifying those exposures within the client portfolio. If I look at it from an allocation perspective, there is no one set amount that is out there that this should be the amount of alternatives that should be in a portfolio. We have clients that have large amount of liquidity requirements and they might have no alternatives or 5–10% alternatives. We have clients that have up to 90% alternatives in their portfolios. But if I take the tails out, I would say that in an ultra high net worth portfolio on average, anywhere between 35 and 40% of asset allocation is towards alternative investments.
Interesting. Okay, let's talk a bit about the opportunities and alternatives from your perspective. And again, your world focuses on, and correct me if I'm wrong, but more real estate, mortgages, infrastructure, and private debt. Mm-hmm. When you look out right now, what are some of the opportunities you're seeing in this economic environment?
Yeah, absolutely. And actually, just picking up on that conversation, really do think of alternatives in the context of TD Asset Management as private asset classes. These are non-publicly traded investments. And that's right, it is a broad world, an exciting world, where we have seen a lot of opportunities in the last couple of years have actually been across all four of those asset classes. Debt has been the most natural place where we've seen yields in our mortgage fund that are at historically high levels in terms of income returns near 7% on an annualized basis. Private debt as well, and why? Because ultimately with the rise in interest rates, the inflation, et cetera, that raises the bar in terms of where central banks around the world have been. Now we land at a premium to that bar, and so our investors have benefited from that. The key, however, is the quality of the underwriting and the credit quality. So not just the income, but also avoiding situations where folks default. So the underwriting's been really important. On the equity side, on the infrastructure, you just think about the broad dynamics that we're going through in society. We don't have enough money as a society to pay for key infrastructure investments that we need to make across the world. We also have net zero transition. That is also quite important, the climate crisis and the like. Infrastructure is a way to play a role in that solution while also attracting a good financial return. And so we've had the opportunity to play in that space to provide solutions, for instance, in green energy, but also around essential infrastructure, for instance, around airports. On the real estate side, you can extend that further. Housing crisis, a very significant moment for our entire world, but including here in Canada. commercial real estate is a way to play a role in providing that solution while having accretive investment outcomes.
The interesting thing as well too, and Syed, you mentioned this a bit, is just part of this, I won't say it's counter-cyclical, but these are much more steady. But again, assuming people don't have the liquidity need in the short term, these are sometimes things that need to get put in for a longer period of time.
Yeah, that's right. They are not trading assets. And
right.
by that, I mean, if you just think about the context, it's a big shopping mall or a warehouse. You have transaction costs to acquire, just like you would acquiring a home. It's very difficult to acquire a home and then look to sell that home 2 months later. Mm-hmm. So similarly, these are what we like to say generational assets, where you create not just generational wealth over time, but you also benefit from the income and the income growth that those assets generate. At the end of the day, the majority of the value creation should come from that income. The preservation of that income and the growth of that income and the activities around the growth of that income.
Syed mentioned we have a number of people who are obviously quite overweighted, I'll say, in Canadian real estate, just from a personal standpoint in terms of what they own and in different places. Maybe you could just take the conversation about real estate from an alt perspective and how you look at, because we're not talking about residential Canadian real estate often. We're talking about these, infrastructure and some of these really interesting commercial real estate opportunities.
Yeah, that's right. We do invest around the world in over 20 countries, 4 continents, and so there are a multitude of opportunities around the world. Why? Because we play differently around the world, right? In Canada, a lot of the discussion is around office and are we going into the office, et cetera, et cetera. Even within Canada, the answer differs depending on the city. But let's go outside of Canada. You go to a place like Tokyo, a place like Singapore, folks are in the office 5 days a week. And so the dynamic in those markets is less about the office, actually, and more about attractive pricing opportunities in the office. So it's the regional variation is very important. We also have great population growth happening in different places around the world. Australia is a good example where they've had historically high levels of population growth, and that spurred investment in multiple areas in real estate. In the UK, in the Nordics, we had a trade down in values, and we're seeing the value adjustment in this part of the world. The UK, the Nordics are about 9 months ahead of us. And so now investors around the world are looking at property that, again, have generational value, but are valued 20%, 25% lower than where they were 12 to 18 months ago, and are saying there's an accretive opportunity to invest in real estate, some of which has been around for a long time, and now here's an opportunity to step in at really good values.
And I know I need an hour probably to ask you about all this stuff as well, but even when you think about like data centers and those types of things, like these are, we say real estate, but a lot of this is industrial in nature, and there's a huge change happening right now, industrialization.
Yeah, that's absolutely right. I mean, over the weekend I was actually explaining it this way. Commercial real estate is where we live, work, and play our daily lives in every facet. So it's not just the 4 main food groups, the office where we work, where we shop, the retail, where we get our Amazon packages through, the warehouse where we live, multi-unit residential apartments, but it's also where we go to socialize in a lobby of a hotel, for instance. It's where you get your data through the data center that goes into infrastructure. It's where you stay when you're studying at a university, student housing. And so, yes, there are actually incredible opportunities in all of these other areas of real estate. We call it alternatives real estate to make it even more confusing. But that area has been around for generations, but what is happening today is we are actually making this area an attractive investable asset class. And so we have that area within our portfolios, but as an industry, that's a huge development going on, not just in Canada, but around the world.
ESG portfolios, let's ask about that as well too. How does that play in terms of how you think about ESG and how it's expressed, I guess, in this way?
Yeah, ESG, environmental, social, and governance, all 3 are absolutely critical. A lot of folks will focus on one, i.e. environmental, and ignore social and governance. If you're in the real estate space and you own and operate spaces where people live, work, and play, really important that those spaces serve the community around them, the people running those spaces are representative of the community, understand the community, but also those spaces help our climate, right? So ESG, whether it's on the infrastructure side, really important to partner, for instance, with Aboriginal communities on whose land you might be operating on or partnering with. So it is not just, okay, are we going to go towards a net zero objective and at some point in the distant future? It is, what are we doing today in the here and now to actually create solutions? Are we building net zero industrial warehouses? Are we looking at the diversity of the staff that are running companies, the operating companies? Are we practicing good governance? Are we having independent looks at what we are doing? Right? Those are examples of ESG, and it's incredibly critical to integrate it, not just in the end reporting, but in the investment process as a key component of that process.
It's fascinating. Syed, I guess we'll go from ESG and I'll go to another acronym, ESP, and this is endowment style portfolios. Maybe tell us a bit about this and what you're seeing right now.
Yeah, absolutely. So endowment style portfolios is often correlated with ultra high net worth asset allocation. And essentially what endowment style portfolios are, it's a term that became quite popular due to large US public endowments from universities such as Yale allocating majority or large parts of their asset allocation towards illiquid alternative investments to earn outsized returns over a long period of time. So we see it as a great portfolio construction learning tool. There's lots of things that we see in endowment style asset allocations that can be transferable over to private clients, but not in the cookie cutter form or in the exact form it can be replicated. And the reason for that is that families have complex liquidity requirements, succession planning, philanthropic goals. Families don't have unlimited time horizons on a forward-going basis, such as endowments might have. And often endowments are dealing with perfectly rational, institutionalized way of working, whereas families have emotions and you're dealing with a lot of behavioral biases, as an example. So when we look at endowment style portfolios, they teach us that the importance of alternatives. So having large amount of alternatives in the portfolio where you are sacrificing short-term liquidity, and if you can afford to do so, pays off in the long term in terms of outsized returns. But we have to just be very careful in terms of how we transfer over those practices over to families, just given all the complexities that are involved.
Right, the ability to lock into some of this generational income and wealth you talked about, but it has to be in the right place, right time, because you need to have it, you need to let it grow. That's
Absolutely.
The point. Yeah, that's a
Absolutely.
key point. I'm curious right now, just to finish up, when you talk about alternatives, what is in demand right now by your clients?
Absolutely. So just to echo what Colin said, private debt is something that really picked up steam post-COVID boom. We had a little bit of a banking crisis out in the US. In general, banks tightened their belts in terms of their lending, and this is where this asset class really stepped in. And we have seen that momentum continue through years like this, where we're seeing still outsized demands by families for private debt, private credit strategies. Private equity continues to be also a very strong asset class right now. We have heard a lot of chatter on the street, so to speak, about the amount of dry powder that exists on the sidelines or the higher interest rates, which could be headwinds toward private equity investment. But what we continue to see is that the private investment landscape continues to grow, the opportunity set continues to grow, whereas public markets continue to contract on a year-over-year basis. So we see that the opportunities are out there. And when we talk to some of the top managers in the private space, such as Colin, what we see is that they actually quite like the fact that interest rates are higher or more normalized, because valuations have become a lot more reasonable. So we're not seeing a lot of the crazy valuations that we saw end of 2020 and 2021. And sticker price is the original sin, so to speak, and we're seeing a lot better value now in that space.
Well, it was great having you both here. I appreciate the update, Syed. Thank you, Colin. Thanks very much.